Welcome back to Talk Tickers. This is the deep dives where we strip away the corporate fluff from earnings calls and get straight to the alpha.
We cut through the noise to find the signal. And today, we have a fascinating print on the desk.
You certainly do. Today, we're looking at W.R. Berkley Corporation, ticker WRB. And I have to say, this is a classic case of boring is beautiful.
It really is. While everyone else is chasing AI hype, this PNC giant they just delivered a masterclass in underwriting discipline.
Right. And, going into this, the market was braced for something completely different.
Oh, totally. The options market was pricing in some serious volatility. They were looking for fireworks, pricing in a swing of about plus or minus 6%.
6% on an insurance stock? That's massive.
It's huge. And it was all based on fear, pure fear. You look at their peers, and we've seen other insurers come out and basically say, oops, we have these massive holes in our reserves.
Right. We underestimated how much these lawsuits are going to cost.
Exactly. So the market was terrified. Berkley was about to drop that same bombshell.
So the volatility sellers were betting on chaos. And what did they get instead?
They got a steady compounding machine. The stock is trading up, about 1.6% after hours?
Yeah, moving from around $66.88 to just under $68. The vol sellers absolutely won this round.
They did. But before we get into the spicy management commentary, and trust me, there is some very spicy commentary, we need to ground ourselves in the numbers.
Let's do it. Let's run through the headlines.
Okay, so operating EPS came in at $1.13. That beat estimates by a penny.
A penny beat, but a high-quality one. Revenue, $3.72 billion, up nearly 6% year over year.
And net written premiums were up 2.1% to $3 billion. But the one that really jumps off the page.
The combined ratio.
89.4%.
That is the golden metric. But let's pause right there. For anyone listening who maybe tracks tech or retail, why is 89.4% such a mic drop number in this industry?
So the combined ratio is, it's the holy grail of insurance efficiency. It basically adds up what you pay out in claims and what you pay to run the company.
Okay.
If that number is 100, you're breaking even. You take in $1 of premium, you pay out $1 in costs. Anything under 100 means you're making an underwriting profit.
So 89.4.
It means for every $1 of premium they take in, they are keeping 10.5 cents as pure profit. And that's before they even touch their investment income.
And that's the key. That's the float Warren Buffett always talks about. They get to invest that profit.
And when you layer that on top, you get a return on equity that is, frankly, just absurd for a company this size.
What was it?
21.4% ROE. And they grew book value by over 15% for the year, even after paying out dividends and buying back stock.
Most banks would kill for a 15% ROE.
Exactly. This is the definition of a compounder.
Okay, let's crack open the hood on that premium growth, because there was a little bit of a scare hidden in the details, wasn't there?
There was. Management flagged that October and November growth was basically flat. And that's the kind of thing that can really spook the algos.
For sure. They see flat growth and the sell orders just start firing.
Right, but you have to look at the context. Rob Berkley, the CEO, he was very clear. He said, while October and November were disappointing, December bounced back with 7% growth.
And January looks encouraging.
It does. But here's the fascinating part. This volatility in their growth isn't a bug, it's a feature.
How is flat growth a feature? Explain that.
It shows discipline. When the rates aren't good, Berkley just walks away. They aren't chasing top-line revenue just to hit some quarterly number.
It's the difference between we need to grow and we need to make money.
Precisely. If the pricing doesn't make sense, they shrink the book. It's exactly what you want your insurer to do, but so few management teams actually have the stomach for it.
And that discipline extends to the expense side too, right? Expense ratio came in at 28.2%.
Yep, and they were explicit. They guided that they expect to keep that comfortably below 30% for all of 2026.
Give us a benchmark. What does a bloated competitor look like?
Oh, many legacy carriers are running in the mid-30s. Some even push 40%. So Berkley, running sub-30, gives them this massive competitive moat. They can be profitable at prices where their competitors are bleeding cash.
Let's talk about the other engine here, the investment portfolio. Net investment income was up to $338 million.
This is the tailwind we've been waiting for. They've also extended their portfolio duration out to 3 years, up from 2.6 years.
So why do that now? What's the strategy?
Locking in the yields. We all know rates have been high, but the Fed is signaling cuts. By extending to 3 years, they're locking in today's higher rates for the next 36 months. It protects their income stream.
And what about the quality? Are they reaching for yield on junk bonds?
Not at all. It's a fortress. The portfolio is rated AA, and management said it's teetering on AA.
So high yield, locked in longer, minimal credit risk.
Mm-hmm.
Okay. This is where it gets really interesting, though. The macro commentary from Rob Berkley.
Yeah, it was. It wasn't the usual corporate speak.
No. He used a phrase about the property market that just stuck with me. The feeding frenzy.
That caught my ear, too. He was talking specifically about large account and shared and layered property.
Let's define that. Shared and layered. Sounds like a cake.
Basically, imagine insuring a giant skyscraper. No single company wants all that risk, so they layer it. One company takes the first 10 million of a loss, the next takes the next 20 million, and so on.
Got it. And Berkley called out London and Lloyd's as the epicenter of this feeding frenzy.
He did. And he backed it up with a stat that made my jaw drop. Their own reinsurance treaty renewal saw a risk-adjusted rate decrease of 19%.
Wow. A 19% decrease.
That is a massive flashing yellow light for the entire property sector. It means supply, capital is flooding the market.
So all that talk about a hard market might be over.
It suggests the easy money and property cat might be behind us. And worse, he said that this competition is spilling over, meaning insurers who can't hit their targets in property because the rates are dropping, well, they have to find growth somewhere else. So they start getting aggressive in casualty insurance just to get volume.
And that sounds like a recipe for a future disaster. Speaking of which, let's talk about auto liability. He didn't mince words there.
No, he just called it ugly.
Ugly.
I mean, that's almost putting it mildly. You have social inflation, nuclear verdicts, rising repair costs. It's just a mess.
But there was a surprise green shoot. Workers' comp.
Yeah, he sounded almost optimistic. He mentioned seeing a backbone reemerging in California pricing.
A backbone in California. That's a rare sighting.
It is. But he added this really important nuance about medical inflation and the link between Medicare and workers' comp.
Okay, I want to drill down on this because it's not intuitive. How does Medicare affect my business's insurance?
It's a cost-shifting game. Medicare pays hospitals and doctors below the actual cost of service. So the hospital loses money on every Medicare patient.
Okay, so they have to make up that margin somewhere else.
Right. They charge the private payers more. And one of the biggest private payers for treating injuries is workers' comp insurance. So when the government squeezes Medicare, the cost just bulges out on the workers' comp side.
I see. It's a hidden inflation driver. That's a very sophisticated view of the market.
It is, and it shows they're thinking multiple steps ahead.
Let's pivot to the structural changes they discussed, the frenemy dynamic with brokers.
This is a huge shift. Historically, the insurer was the factory, the broker was the distributor.
Simple enough.
But now brokers are becoming competitors. They want to hold the pen, do the underwriting themselves. At the same time, customers want self-serve. They want Amazon-like convenience.
And Berkley's response is interesting. Not just buying some off-the-shelf AI, they have 60 different incubator units.
60, it sounds like chaos, right?
A logistical nightmare.
But it's actually a portfolio approach. Think of them as a holding company for 60 different startups. It allows them to test AI and new products in silos.
So if one fails, it fails small.
Exactly. It doesn't sink the ship. But if one works, they can scale it across the whole fleet. It's a venture capital approach to insurance.
So what does this all mean for the shareholder? They returned $68 million in Q4 alone.
And that was on top of $1 per share special dividend in December. Plus, they upped the buyback authorization to 25 million shares.
And that's the real signal, isn't it?
I think so. Management has massive excess capital value. Rob measured it in 10 figures. That's billions of dollars.
And they're generating it faster than they can deploy it because they're being disciplined.
So if they can't write new policies because the pricing sucks, they buy back their own stock. But, and this is key, only when their internal math says it's a good deal.
Okay, let's transition to my favorite segment. Put on your hedge fund analyst vest. Based on this call, what's your wild but plausible trade idea?
Okay, and of course the disclaimer. This is absolutely not financial advice. Do your own diligence. This is just a hypothetical trade structure.
Understood. Lay it on us.
I call it the discipline arbitrage pairs trade.
Ooh. Discipline arbitrage. I like it. How do we set it up?
Simple. You go long WRB. They just told us they're shrinking in the feeding frenzy markets. They have a fortress balance sheet. They are the safe haven.
You're betting on the adult in the room. What's the short leg of the trade?
You short a London market Lloyd's proxy or a pure play property reinsurer. specifically one that's been growing their top line aggressively.
Because they're the ones eating that 19% rate decrease.
They have to be. The thesis is you short the players who must write that volume to survive, to cover their costs. They are chasing premiums down the drain.
Picking up pennies in front of a steamroller.
That's it, exactly.
Yeah.
And the steamroller is the next hurricane or just bad reserve development. The payoff comes when those aggressive players blow up, and Berkley is sitting there on their pile of cash and AA assets, ready to pick up the pieces.
I love it. Long the adult, short the teenager with a credit card. It makes perfect sense based on their commentary.
It's a way to play that soft market signal without taking directional risk on the whole market.
Brilliant. All right, let's wrap this up. Final takeaways for the listener.
Summary is pretty simple. A solid beat, consistent execution, and a management team that just refuses to chase bad business.
And the warning.
Keep an eye on that feeding frenzy in property. It's the canary in the coal mine. If Berkley is stepping back, you have to ask yourself why your other insurance holdings are stepping in.
That is the question of the day. And here's a thought to leave you with. If the smartest people in the room are stockpiling cash and buying back their own stock instead of writing new policies, what does that really tell you about the risk environment out there? Maybe that soft landing is going to be a lot bumpier than we think.
It's a scary thought.
It is. Thanks for listening to this deep dive on Talk Tickers. If you enjoyed this breakdown, hit follow. We will see you on the next print.
Good luck out there.